The nonsense that is market economics. Markets don't work, not least because they don't exist, but that doesn't mean they aren't useful. In any world, society's ideas of rationality and common sense reflect the logic of the systems that underpin that world. In the era of industrial capitalism, the world is dominated by a broad collection of highly formalised systems. Commodity production and a monetary economy are geared to profits, not to mention contracts, bureaucracy, science and technology, legal systems and so on. These, it is assumed, represent a rational way, in fact the most rational way possible, of thinking about organising and living in the world. This rather ambitious claim is typically justified either by the empirical observation that this is just how the world works, or by the idealistic claim that such systems are inherently right and proper, not to mention uniquely efficient and effective, and that therefore this is how the world should work. Given how hard all formal systems of thought, from economics to mathematics, find imagining a world beyond themselves, it comes as no surprise that the modern world so often sees itself as the best of all possible worlds, and even, now that at least the most prominent alternative has shuffled off this mortal coil, the end of history. This is also why, the industrial world being wholly dominated by capitalism, apologists for the modern world typically, though not always, appeal to the market as the ideal. Again, the argument is very ambivalent. Sometimes the market is seen as the best possible judge of what is best for us all, but at other times we talk about the market in much more anxious tones, as though it were an irresistible natural force we just have to submit to, regardless of what the actual outcome is. So why does the market loom so large in discussions of capitalism? Basically, it's because the market is the only aspect of capitalism that can be rolled out to justify capitalism. It's supposed to be the market that ensures universal equality, fairness, competition, opportunity, democracy, and so on. All other elements of capitalism, from wage labour to capital itself, instantly generate a profound unease, as though we sense a deep conflict between the reality of capitalism and any possible notion of justice. In essence, corporate capitalism, state capitalism, and so on all sound rather nasty, not to say sinister. Markets, by contrast, sound positively hygienic. So markets it is. So what is a market? First of all, a capitalist market is a place, increasingly the place, where commodities from butter to insurance, petrol to computers are bought and sold. However, the buyers and sellers who operate in such markets aren't actual people. Like Marx's capitalist, he functions simply as a personification of capital, buyers and sellers enter the market not as real complex human beings, but purely as personifications of money and commodities respectively. From the market's point of view, you only exist if you have something to exchange, and it doesn't give tuppence about you if you don't. In fact, it doesn't even know you exist. Neither your personal needs and desires, nor the subtleties of life in a huge and complicated society count. All that matters is having something to sell and the money to pay for it. Nor are we likely to see the end of this tendency any time soon. In fact, the power of the market seems to grow almost daily. Especially since the 1970s, Western governments in particular have relied upon the market to solve problems that were previously regarded as government responsibilities: housing, education, health, transport, industrial development, and the core economic strategies that underpin the health of society as a whole. At the same time, many non-Western governments have been compelled by organisations such as the IMF and the World Bank to let the market control more and more of their economies too. In neither case is there much evidence that a market-based economic strategy is good for society, and quite a few people are deeply sceptical about whether markets should exercise so much influence over how society works. So the question is, does this idea of the market have any real bearing on capitalist economies? Does capitalism really work through markets? And even if it does, do markets really have the wonderful virtues economists and pundits alike enjoy attributing to them? How real are markets, and how do they really work? The following is a summary of the basic, somewhat overlapping attributes normally associated with free markets. 1. Markets are pretty crowded places, and so they must be if they are to work. There need to be so many buyers and sellers that no single individual or group can control the market, for example by fixing prices or cornering suppliers. So prices are fair. 2. You have a real choice. Multiple vendors offer alternative products. If they aren't absolutely identical, the differences are known and understood. 3. No single buyer is big enough to control prices either, a key issue when selling to a government or a corporation. You'll be paid what your product is worth. 4. All buyers and sellers are economically rational. Sellers rely solely on their product's utility and value to sell it. If a commodity is offered for a given price, it is a price at which the supplier can make an acceptable profit in the relatively short term. Likewise, for the price a buyer is willing to pay, it represents what they sincerely consider to be reasonable value for money. They don't engage, for instance, in hoarding, but neither are they compelled by extreme want or other forces beyond their control to buy things that they don't really want for prices they can't really afford. 5. Markets operate by balancing supply and demand. Prices are elastic enough for there to be a strong tendency towards a uniform price for the commodity in question, at that quality and so on. 6. Rigid or excess prices will always be quickly eroded by the intervention of other sellers offering an alternative. 7. Conversely, prices are biased by non-economic factors such as government subsidies, taxes, price controls and so on. 8. Buyers and sellers all have complete, up-to-date knowledge of the products and prices they are interested in. 9. There are no obstacles to buying and selling. All buyers and sellers have complete freedom of choice, and there are no practical hindrances to buyers and sellers finding or trading with each other. 10. There is free entry into the market. Only a relatively limited investment is needed for a new seller to enter the market if the price is right. There are no non-price barriers to entry, etc. 11. There is also free exit from the market. Few losses are incurred on leaving. The timescales of your various investments don't make it prohibitively expensive to leave, etc. If all these descriptions were true, markets would indeed be characterized by what economists like to call perfect competition. It's even possible that a market economy would deliver some of the benefits modern economists like to tell us the market brings: the greatest possible choice, constantly high value for money, maximum efficiency, minimum costs, life, liberty and the pursuit of happiness, and so on. So it's a pity that none of the attributes listed above describes actual markets. The reality is very different. What is more, it always has been. There never was a golden age of real capitalism when markets ruled. Leaving aside the contradictoriness of markets, for example their propensity for creating bubbles, crashes, and the very concentrations of capital that allow corporations to defy any attempt to control them, it's not exactly difficult to identify factors that undermine market economics at the most fundamental level. 1. In reality, many, probably most major markets are dominated by just a few players, so competition is at best minimal and at worst illusory. For example, all of the following are dominated by just a few corporations: the mass media, big tech, fossil fuels, the finance sector, retail banking, insurance, pensions, investment banking and so on, software development, car and truck manufacturers, aerospace, telecommunications, airlines, pharmaceuticals, processed foods, chemicals, clothing, supermarket chains, and many others. Likewise, when you look along the supermarket shelves at all those apparently different kinds of washing powder, bear in mind that most of them are actually produced by just two manufacturers, Unilever and Procter & Gamble. Procter & Gamble alone make Ariel, Daz, Bold, Dreft, Fairy and Tide, which is itself the highest selling detergent brand in the world, with about a seventh of the global market. 2. We have entire industries, advertising, marketing, public relations, dedicated to ensuring that we do not have perfect knowledge or even a rational opinion of the goods and services on offer. The global advertising market was worth $615 billion in 2022 and is expected to reach $835 billion by 2028. This is a lot of money just to make sure that products that to all intents and purposes are the same, or even worse than the alternatives, at least look different, and may be a bit special too. 3. To the extent that markets exist at all, they aren't actually driven exclusively, or indeed mostly, by supply and demand. Loss leaders, price gouging, buying up competitors, and other stratagems that lack any economic justification are commonplace, designed not only to distort the market, but also to drive legitimate competitors out of business. Netscape, anyone? 4. Any number of non-economic factors distort markets massively: taxation, regulation, politically motivated subsidies, dumping and so on. In Europe and North America particularly, yes, the great citadels of the free market, tariffs and other kinds of control over trade have been absolutely the norm since at least the 1880s. Whatever the political and economic rhetoric, only when a country has achieved complete economic dominance and therefore know they are going to win any economic fight, for example the UK in the 19th century or the USA until recently, only then are they opposed to tariffs. All such factors have the general effect of rendering appeals to the market practically irrelevant, if not downright hypocritical. 5. Where regulation exists, it's by no means opposed by participants in the market, and least of all by the corporations who are constantly complaining about it. Who regulates the regulators? Increasingly it is the regulated themselves. Their personnel co-opted, no charge, to government departments to help with writing all those tricky rule books and laws. Regulation is, and always has been, a problem not of market economics but of powerful corporations abusing their power to fix the market. 6. Cronyism and political favours are rife. Just look at the UK Conservative government's blatant corruption during the COVID-19 pandemic, and if that isn't enough, try the US defence and health sectors. 7. There are many industries where the amount of capital you need to even start up is so enormous that practically everyone who isn't already a major corporation is excluded. Building a single offshore oil rig currently costs around $650 million, a car plant even more. These sums are well beyond anyone but exceptional concentrations of capital or national governments, and they distort the real economics of production and investment, and with it market dynamics. 8. The same applies to the cost of exiting from an existing market. For example, for the current fossil fuel industries to be closed down, gigantic investments would have to be abandoned, probably wiping out most oil and gas companies with them. So, corporations and governments go to inordinate lengths to sustain themselves in the market, regardless of its irrationality from any market perspective. Again, the extra costs bias not only the actions of individual companies, but also the structure and functioning of the market as a whole, not to mention, in this case, the world economy. 9. The real world is awash with externalities that would have to be included in prices before market economics could offer an effective mechanism for managing our collective social lives. For example, the environmental impact not only of the production of goods and services, but of factors such as energy supply or transport to markets, is almost universally excluded from prices. They fall instead either on the wider society, for example in clean-up costs, or on the environment itself. These costs, which could only be realistically enforced by regulation, are excluded from market prices by a combination of corporate influence and political reluctance to damage the national interest, i.e. the interests of political donors and allies, or the capitalist economic system as a whole. 10. To a very large extent, the creation of new products depends on research carried out by the public sector, military research establishments and universities, or paid for by government grants, tax breaks, and so on. The cost of this research is never reimbursed to the public in full and is used to benefit selected players in the interest of national and political goals. Again, the market plays very little role in this quite enormous segment of the economy. And so on. Yes, there are markets, if by market you mean a place where a mass of strangers meet to exchange things for money. But if you mean a place where these exchanges benefit society as a whole through the theoretical merits of the market, as economists and right-wing pundits use that term, then no, there are very few markets, and quite probably none at all of any great significance. Nor is this simply because there are very few pure things in the world, so we should stop complaining about the absence of perfect competition. The fact is, it is, and always has been, the capitalist system itself that is the real threat to markets, and the current state of capitalism's very impure markets is a far more authentic measure of what capitalism really means than the economist's fanciful vision. The case of regulation is especially revealing, not only because it is so widespread, but also because, as already noted, it benefits business, and notwithstanding the noise that surrounds this topic, it is business more than anyone that wants it. There are many reasons why business might want to resist regulation, but as George Stigler, the doyen of regulatory theory and a leading member of the notoriously pro-capitalist Chicago School, put it, the business community does not wish to be released from the public interventions to which it is subject. Each industry will agree upon the desirability of making other industries freer and more competitive, but will assert that its own industry would become disorganized and perhaps even non-viable if the state withdrew. In short, the principal driver of business regulation is neither the regulators nor governments. It is business itself, which invests enormous sums every year in defining and policing public and industry regulations. And the reason for this is because that regulation serves business's interests. Regulation is cheaper, more predictable, and allows business to focus on things that they think are important, not whether or not this nut and bolt will fit that product or whether we can believe anything our competitors are saying, but what the right product and the right strategy are for a changing market. In short, The traditional notion that markets are controlled by the free interaction of supply and demand, or that we are all operating as economically rational actors, is so far from being true that a whole branch of economics, the theory of imperfect competition, has developed to deal with the problems of the fantasy of perfect competition. Yet there is still a tendency, especially among non-economists, to imagine that perfect markets are in some sense the norm and that therefore we live in a market economy. In reality, free markets aren't even an option. Far from imperfections in the market being purely localized or just noise in the system, it's these imperfections that define the economy. In fact, even where competition remains, modern corporations have far more in common with one another, far more shared interests, than they have with workers and consumers. Although in small ways they do still compete with each other, all corporations stand in exactly the same predatory relationship to their customers, their workers, the general public, regulators, governments, and indeed to nature. And as globalization unfolds, this will become more and more the case. So, although corporate competition may cause businesses to modify their behaviour, it becomes less and less likely that it will moderate their exploitative relationship to the population as a whole, or therefore benefit society as a whole. So market economics is at best a marginal element of modern economies. Indeed, actively controlling the market is a key element in every large corporation's business strategy, constantly reinventing it to serve their own interests. To the extent that they succeed in doing this, they subvert the market entirely, for the market is surely defined by the freedom and equality of its participants. But that would be a state of affairs no corporation could possibly tolerate. In fact, if we consider the effect of business strategy as a whole, it's hard to see how it leaves any room for markets at all. On the contrary, businesses demand tax breaks and subsidies. They demand to use and even own the research and inventions created by publicly funded universities and military research. They demand regulation in their own interests, and they actively interfere in government to get their way by means of lobbying, media manipulation, outright bribery, and revolving door employment of public servants and politicians. And the effect of every single one of these actions is to undermine the workings of the market. So why does the myth of the market as the arbiter of our economic system persist? It is always difficult to know what motivates economists and even more journalists, politicians and business people. However, it is not hard to identify the value the concept of the market offers. 1. The market creates the impression of universal popular involvement via a kind of economic democracy. This is the main reason for its slightly more hygienic image than, say, capitalism itself. 2. The market gives the impression of economic equity, of buyers and sellers meeting freely and as equals, despite the fact that most of the transactions in which most individuals are involved, in the supermarket, the labour market, and so on, are massively skewed towards one side. 3. The market implies that there is something profoundly rational about capitalist economics, an infallible force ensuring that we arrive at the right answer regardless of our own personal limitations and follies. 4. The market, and in particular the idea that it will transform a mass of self-interested activity into the greater good, converts the reality of selfishness into the illusion of social responsibility. 5. The market conceals economists' ignorance of, or reluctance to admit, how capitalist economies really work. 6. The market distracts us from capitalism's inevitable immense concentration and centralization of capital, which permits an ever-smalling ruling class to wield ever greater economic, political and social power. 7. The market absolves politicians from responsibility for the fate of society as a whole. 8. The market vindicates the exploitation of working people, from the extraordinarily one-sided reality of employment to the extraction of surpluses these workers alone create, to the right of working people to wield comparable collective power to shareholders in the form of trade unions. 9. The market hides the very real and intentional role played in the market by political and ideological players who would prefer the general public not to know what they are up to. 10. The market keeps major companies hidden from the view of the general public, and so free of criticism even for the performance of the economy they control. For example, when Joseph Stiglitz, professor of economics and winner of the Nobel Memorial Prize in Economic Sciences, refers to the tendency of markets to adjust upwards more rapidly than they adjust downwards, he creates the impression that this is simply an unfortunate side effect of a force of nature, as though he were describing the regrettable tendency of gravity to kill people who fall off tall buildings. In reality, he should be describing the speed with which actual capitalists choose to put their prices up as soon as they have an excuse, compared with their reluctance to bring them down again until they are forced to do so. For example, compare how often price rises rise with how seldom they fall. In other words, as far as capitalism is concerned, the public don't just fall off tall buildings, we are pushed. But talk of markets hides who is doing the pushing and how they acquired the power they wield over us. A real market with real competition would soon force prices back down again, but capitalists are mostly on the same side, and none of them are on the side of the general public. So effective downward pressure arises only when other factors are brought to bear. Again, all this is concealed by talk of the market. Last but by no means least, the market is the validating corollary of the idea of private property, upon which the entire idea of capitalism rests. Private property is presented as meeting in the market and engaging in fair and equal exchanges, but in reality billions of dollars of private property sits on one side of most exchanges, and a property-less individual only a few paychecks away from hunger sits on the other. Ultimately it comes down to Adam Smith's doctrine of the hidden hand and the fantasy that markets have a magical power to spread freedom, equality and fairness wherever they are allowed to control. However, the hidden hand is not so much hidden as non-existent, while the hands that manipulate the economy are very real and not hard to identify, hiding in plain sight. Indeed, given the wealth and power they wield, they have no need to hide. On the contrary, their very acquisition of such enormous wealth and power makes them admired, even revered. As already noted, it's possible to believe that the shortcomings of capitalist markets are essentially practical and political failings, and abuses of the system rather than inherent in the logic of capitalism as such. That's certainly what economists would like you to believe. But to believe that would be to deceive oneself, for it is the most essential logic of capitalism that has created this historical conjuncture, and it is impossible to imagine how it could have done otherwise. The more capitalism continues to be itself, the more inescapably what few fragments of the market there might be are dissolved, even while, with characteristic contradictoriness, the system's enthusiasts insist more vocally than ever that we should let the market have its way. This raises a further failing of markets, that the elements that undermine them are always under the control of the capitalist or their political allies, and never in the hands of either worker or consumer. It is only capitalists, perhaps through their political proxies, who can realistically distort market information, social values and public imagery, exercise unwarranted market control, for example by cornering the market in key resources, demand political interventions such as tax breaks, subsidies and preferential treatment, create illusory competition, for example multiple brands belonging to the same company, and so on. Unions can counter corporate power in limited ways, but this is only possible at immense cost to workers themselves. All in all, the more fully capitalism develops, the less valid the market model becomes. Historically speaking, there never was a time when markets explain capitalism in general, but increasingly the market is a fig leaf for an increasingly one-sided relationship between capitalism, society and nature. In the end, it degenerates into little more than a rhetorical device employed to deflect criticism from the real behaviour of individual firms and the exploitative nature of the system as a whole. Meanwhile, economic theory has long since sloughed off the elements of classical political economy, such as the labour theory of value, that cast doubt on the bourgeoisie's claim to heroic creation of the modern world. Now all they ask is that the dismal science confirm that the sordidness of the world capitalism has created is not their fault.